Disinflation is a decrease in the rate of inflation, a slowdown in the rate of increase of the general price level of goods and services in a nation's gross domestic product over time. It is the opposite of reflation. If the inflation rate is not very high to start with, disinflation can lead to deflation, decreases in the general price level of goods and services. For example, if the annual inflation rate one month is 5% and it is 4% the following month, prices disinflated by 1% but are still increasing at a 4% annual rate. If the current rate is 1% and it is the -2% the following month, prices disinflated by 3% and are decreasing at a 2% annual rate. There is widespread consensus among economists that inflation is caused by increases in the supply of money available for use in a nation's economy. Inflation can also occur when the economy overheats because of excess aggregate demand. This is called demand pull inflation. The causes of disinflation are the opposite, either a decrease in the growth rate of the money supply, or a business cycle contraction, recession. During a recession, competition among businesses for customers becomes more intense, and so retailers are no longer able to pass on higher prices to their customers. In contrast, deflation occurs when prices are actually dropping. If disinflation continues until the inflation rate is zero, the economy enters a deflationary period, with decreasing general prices on all goods and services produced. An example of this happened during the month of October 2008, when U.S. consumer prices fell, deflation, by 1.01%, but the overall annual inflation rate simply decreased, disinflation, from an annual rate of 4.94% to 3.66%. So the distinction between deflation and disinflation at that point was simply one of which time period was being referring to, the monthly basis or the annual basis. Over the year, prices were up 3.66% while over the month prices were down 1.01%. Deflation is a sustained decrease in the general price level, after inflation drops below 0%, resulting in a sustained increase in the real value of money and other monetary items. Money and other monetary items are worth more all the time during deflation as opposed to being worth less all the time during inflation. Deflation is negative inflation. Disinflation is lower inflation. Prices are still rising during disinflation, but at a lower rate. The general price level still rises, but at a slower rate, resulting in a continued, but lower rate of real value destruction in money and other monetary items. A lowering of inflation is not deflation but disinflation. Deflation means the general price level is not increasing at all, but actually decreasing continuously, and the internal functional currency, money, and other monetary items are worth more all the time. Deflation causes an increase in the real value of money and other monetary items. Disinflation happens after a period of higher inflation in what are normally considered low inflation economies and is initially popularly confused with deflation. During disinflation, many prominent prices, for example, oil, fuel, commodity, property, and food prices are falling, but the general price level is still actually rising, albeit at a much slower rate than during normal low inflation. When the slowing annual inflation rate moves lower and lower, it eventually gets to a 0% annual rate for maybe a month or two. When the general price level then continues to decline even further, below 0% per annum, the economy moves from inflation to deflation, not just a slower increase in the general increasing price level as during disinflation, but actually a sustained decrease in the general price level below 0% per annum, which causes an increase in the real value of money and other monetary items, the opposite of inflation or negative inflation. Disinflation is a decrease in inflation rates. In simple terms, a decline in the rate of increase in the general price level of goods and services in the gross domestic product, GDP, of a country over time is called disinflation. Unlike inflation and deflation, which refer to the direction of prices, disinflation refers to the rate of change in the rate of inflation. Disinflation is not considered problematic because prices do not actually drop, and disinflation does not usually signal the onset of a slowing economy. A healthy amount of disinflation is necessary since it represents economic contraction and prevents the economy from overheating. Disinflation is considered the opposite of reflation, which occurs when a government stimulates an economy by increasing the money supply. Causes of disinflation. Many reasons can cause disinflation in an economy. If a central bank wants to enforce a tighter monetary policy and the government starts selling off some of its assets, the supply of money in the economy could be limited, causing a disinflationary effect. Similarly, disinflation can also be caused by a contraction in the business cycle of recession. For instance, companies may choose not to raise prices to gain more significant market share, leading to disinflation. Disinflation is commonly used to describe a period of slowing inflation. It should not be confused with deflation, which can be harmful to the economy. Unlike inflation and deflation, which refer to the direction of prices, disinflation refers to the rate of change in the rate of inflation. Disinflation is considered the opposite of reflation, which occurs when a government stimulates an economy by increasing the money supply. A healthy amount of disinflation is necessary since it represents economic contraction and prevents the economy from overheating. As such, instances of disinflation are not uncommon and are viewed as normal during healthy economic times. Disinflation benefits certain segments of a population, such as people who are inclined to save their earnings. Several things can cause an economy to experience disinflation. If a central bank decides to impose a tighter monetary policy and the government starts to sell off some of its securities, it could reduce the supply of money in the economy, causing a disinflationary effect. Similarly, a contraction in the business cycle or a recession can also trigger disinflation. For example, businesses may choose not to increase prices to gain greater market share, leading to disinflation. How is disinflation different from deflation? The key difference between disinflation and deflation is that the former is always positive but decreasing, while the latter is always negative. What causes disinflation? Disinflation is usually caused by contractionary monetary policy, e.g., rising interest rates. It can also arise from increases in productivity and technology. What happens to the economy during periods of disinflation? Past periods of disinflation have caused recession/economic slowdowns that resulted in higher unemployment and lower corporate earnings. What happened to the economy during the last period of disinflation? Academic research shows that the economy suffered 2 recessions and higher unemployment during the last sustained period of disinflation, in the early 1980s. Many people know that inflation is a rise in the overall price level. Many people also know that deflation is a fall in the overall price level, that is, the rate of inflation is negative. But fewer people are familiar with the path from inflation to deflation, disinflation, a situation in which the inflation rate is falling. Like a runner who slows down but still propels forward, when there is disinflation, prices may still be rising, just at a slower rate than before. Disinflation can be good news or bad news. It is a good thing if it comes from increases in productivity and technology, like those that helped keep inflation low in the late 1990s. More commonly, disinflation is brought about by contractionary Fed policy. In such episodes, disinflation is intentional and welcome. This was especially the case during the most favorable disinflation episode in the Fed's history, the early 1980s, when inflation, as measured by the year-over-year change in the Personal Consumption Expenditures Price Index, declined from more than 11% in early 1980 to an average of roughly 3.5% in 1985. Though high inflation hasn't been a problem since, the goal of tighter monetary policy is generally to produce modest disinflation to get inflation closer to the central bank's target. There is even such a thing as opportunistic disinflation, the name that former Fed Governor Lawrence Meyer gave the monetary policy strategy of allowing the economy's inevitable recessions to ratchet down inflation over time. Under this strategy, the central bank would sustain boom periods with low rates but jump the gun slightly on raising rates after recessions to preserve the lower rate of inflation and the reduced inflation expectations that help keep inflation down. The result would be gradual disinflation, with perhaps some short-term cost in terms of unemployment but long-term gains in reducing the distortions of inflation. Though some have suggested this was the Fed's strategy during the 1980s disinflation, the Fed is less commonly believed to have been following this strategy in the last 20 years, when inflation has generally been low. At those low inflation rates, opportunistic disinflation could risk reversing a recovery and tipping the economy into deflation, and large declines in the overall price level can be a self-perpetuating trap. Policymakers tend to get particularly concerned about disinflation when inflation falls below 2%, the Fed's official goal since early 2012. In recent history, there have been two notable episodes of disinflation sparking deflationary fears. In 2003, when the economy was still limping out of the 2001 recession, core inflation, total inflation minus the volatile categories of food and energy, often a better measure of current inflation for policy-making purposes, fell steadily to 1.3%. And more recently, core inflation fell from 2.3% in mid-2008 to roughly 1% a year later. After climbing back up, it plunged to 1% again 18 months later. In both disinflation episodes, many economists talk seriously about the risk of deflation. In 2002, former Fed Chairman Ben Bernanke, then a governor, made a famous speech outlining how to prevent something like Japan's decades-long bout with deflation. He said the chances of deflation were quite low, but also that deflation is notoriously hard to predict. That's partly because monetary policy works with a lag, and partly because it is not always obvious why inflation has fallen. For example, 2004 research by Richmond Fed economist Andrew Bauer and then colleagues at the Atlanta Fed showed that the U.S. disinflation of the early 2000s was driven primarily by falling housing and car prices, for reasons unique to those sectors and unrelated to the economy's overall weakness. Therefore, Bernanke said, the very best medicine for deflation is to never get into it in the first place. Put differently, be vigilant in disinflation episodes for threats of deflation. The Fed lowered interest rates in 2003, with some Fed policymakers urging even larger cuts. When the Great Recession hit in 2007, by contrast, there was little doubt that monetary policy should ease aggressively. After pushing interest rates to near zero in late 2008, the Fed added some unprecedented policies, such as massive asset purchases, often called quantitative easing, or QE, to pump the banking system full of reserves and, hopefully, stimulate growth and mitigate any risk of deflation. When the disinflation trend resumed throughout 2010, the Fed initiated a second round of QE starting that November, and a third round began in September 2012. Today the economy has recovered considerably, unemployment has finally fallen below 6%, and QE officially ended in October 2014. But inflation remains below the Fed's goal of 2%. The economy seems to have improved enough that most Fed policymakers have not expressed concern about continued disinflation or outright deflation. Instead, today's policy debate has centered on how quickly inflation is likely to return to the 2% goal, and accordingly, whether it is worth holding rates low for a lot longer, risking a little inflation to boost employment further. Disinflation refers to a slowing in the rate of inflation, typically when it eases over the short term. Proponents of disinflation argue that it's necessary to prevent the economy from overheating, while opponents say that it can lead to a downturn or cause deflation, as it represents economic contraction. Disinflation typically arises from a reduction in the money supply that results from rising interest rates, but it can also come about by productivity advancements or companies raising prices at a slower pace during a contracting business cycle. A period of disinflation in the early 1980s indicates the economy may contract over the next few years if history repeats. Thank you for watching this video.